All right, so you've got some questions about the global economy, huh? Everyone wants to know where to put their money these days.
Yeah, that's the million-dollar question, isn't it?
It really is.
Especially with all the geopolitical craziness and the U.S. economy sending such mixed signals.
Exactly. And that's why we're diving deep today into these Array Day newsletters you sent over, plus some sections from that Jeffereis report, Asia Maxima.
Sounds like you're trying to make sense of it all right for your own portfolio.
Trying to see the signal through all the noise. Yeah.
I hear you. Well, it seems like a good place to start is with that geopolitical landscape. It's it's a bit of a mess out there, wouldn't you say?
Total mess. Both sources seem to agree on that much. The U.S. election obviously throws another wrench in the works. Plus, you got the Middle East, Russia, Ukraine. It's like trying to predict the weather in a hurricane.
And markets absolutely hate surprises.
Right. So how can you possibly make informed decisions when the ground is constantly shifting like that?
Well, the Jefferies report actually makes an interesting point about that. They say that this unpredictability, this inability to model for what if on a geopolitical scale is pushing some investors towards assets like gold and Bitcoin.
Ah, so that's where those Arret newsletters come in. They were really high on both of those, calling them essential hedges.
It's that whole flight to safety mentality.
Yeah.
When traditional systems feel shaky, people look for something that feels solid, something that's held its value for centuries.
Like stashing cash under the mattress, but digital.
In a way, it's about finding assets that are detached from those traditional systems, things that might hold up even if, let's say, G7 currencies see some serious devaluation.
Okay, so we've got geopolitical storms brewing. But what about the U.S. economy itself? Is it actually as strong as some people say, or are we headed for a recession? The Jefferies report seemed a little conflicted on that.
Yeah, it's like different parts of the economy are reading from different scripts right now.
What do you mean? Give me an example.
We'll take the bond market. It's been rallying, which usually means slower growth ahead. But then you look at corporate profits, they're strong. And the job market, still super tight. So what's the real story?
Yeah, it's enough to make your head spin. So are we slowing down or not?
Well, the report suggests maybe it's a bit of both. They talk about the lag effects of the Fed raising interest rates.
So even though they've cut rates recently and hit pause on that quantitative tightening thing.
Right. Even so, those previous rate hikes might still be working their way through the system. It's like a delayed reaction.
Okay, so delayed reaction from the Fed. But what about the government's role in all this? They're spending their taxes. Surely that has to impact what the Fed is doing too.
It absolutely does. The report actually argues that the line between what the Fed does, monetary policy, and what the government does, fiscal policy, is getting really blurry.
Blurry lines. What does that even mean for the average investor?
Basically, it means the Treasury Department, by issuing all these short-term bills to cover the deficit, might actually be working against the Fed's efforts to tighten things up.
Wait, so one part of the U.S. government might be undermining the other when it comes to managing the economy.
That's what the report suggests. They call it stealth QE. Essentially, all those short-term bills are flooding the market with assets that act a lot like cash. And that can make it tougher for the Fed to control inflation, even if they are raising rates. It's like trying to slow down a car while someone else is hitting the gas.
Okay, so we've got a financial thriller playing out in real time. Speaking of economic thrillers, the report also spends a good amount of time on China. What's the picture they're painting over there?
It's a mixed bag, really. On the one hand, China's government is going all in on stimulating their economy.
Right, they're cutting rates, pumping money into the system,
Yeah.
trying to get things moving.
Exactly. But there are still some big question marks hanging over them. Like, how effective can these internal measures really be when you've got all these external factors working against you?
So what are the weak points?
Well, the report highlights weakening foreign direct investment. So less money flowing into China from overseas. That's not exactly a vote of confidence, is it?
Not really. What else?
They're still massively reliant on exports. So if global demand slows down, which a lot of analysts are predicting, China's in a tough spot.
So it's a bit of a tightrope walk for them. Internal push for growth, but some serious external headwinds to navigate.
That's a good way to put it.
Hey,
But hey, at least they're trying, right?
true. Okay, so we've got China trying to find its footing. But let's get to the part I think a lot of people listening are really interested in: investments. Both the Arate newsletters and the Jefferies report had some thoughts on how to navigate these crazy markets. What are the key takeaways?
Well, Arate is still all in on gold and Bitcoin. Remember they called them essential hedges.
Right, because who knows what's going to happen with currencies like the dollar if inflation keeps chugging along.
Exactly, and the Jefferies report actually backs that up. They dedicate a whole section to analyzing gold's performance in times of uncertainty.
Which is kind of their whole thing, right?
Yeah,
Gold as a safe haven when everything else is going haywire.
exactly. And they point to a bunch of factors supporting gold right now, like central banks in the G7 moving towards easier monetary policy.
Like we were talking about earlier with the Fed cutting rates.
Exactly. They say that combined with government spending more than they're taking in, raises the likelihood of currency debasement.
Meaning the value of currencies like the dollar going down?
Exactly. And when that happens, people tend to flock towards assets that are seen as more stable, like gold.
So it's a classic hedge,
Yeah.
but are they as bullish as the rate folks?
They're definitely optimistic. They even give a price target $2,500 an ounce by the end of 2025.
Whoa, that's a pretty bold prediction.
It is, but they're clear that this is a long-term outlook, not a get-rich-quick scheme.
Got it. So patience is key, which makes sense. But what about gold's digital cousin, Bitcoin? Any love for that in the report?
There is. They actually have a whole section dedicated to Bitcoin, analyzing its potential in today's world.
Okay, and what's their take?
They acknowledge that it's still not mainstream. Not as easy to use as dollars or euros yet,
There's still that Wild West feeling when you talk about crypto.
for sure. But they do say it is becoming more mainstream. Things like the recent approval of spot Bitcoin ETFs in the U.S. are making it much easier for everyday investors to get involved.
Makes sense. I remember trying to figure out how to buy Bitcoin for the first time. It felt very intimidating. A lot easier now.
Right. And the report highlights growing interest from big institutional investors. Plus, more and more businesses are starting to accept it as payment. So while it's not mainstream yet, it's definitely moving in that direction.
Steady progress. Anything else about Bitcoin stand out to you?
Yeah, their discussion of the geopolitical implications was interesting. Because it's decentralized, it's by its very nature free from government control.
Right. So it's like the ultimate escape hatch from the traditional financial system.
Exactly. Which is why it holds so much appeal in the current climate, with U.S.-China tensions and the BRICS nations challenging the established order. It's like a hedge against geopolitical instability.
So we've got gold and Bitcoin as potential safe havens. But what about specific markets? Arese mentioned their Asia strategy. Anything noteworthy there?
Yeah, they're pretty down on Hong Kong, actually, citing something called asset deflation as a major concern.
Asset deflation. So like the opposite of inflation? Things getting cheaper?
Basically, yeah. They expect prices, especially in real estate, to keep dropping.
Ouch. Not exactly a hot investment then.
Not at the moment, anyway.
But they are high on India.
Oh, yes. India. Always hear a lot of buzz about India. What's their reasoning?
They see strong signs of a private sector capital expenditure cycle there. Basically, businesses are investing in new projects and expansions. And Jefferies seems to agree.
That's got to be good for the overall economy, right?
Exactly. More investment, more jobs, more growth.
Oh.
They even draw a parallel to a similar cycle in India back in the early 2000s, which led to a huge boom in their stock market.
So history might repeat itself.
It's a possibility for sure.
Yeah.
The report does point out that the Indian rupee has weakened against the US dollar, which has its own pros and cons. Right. Imports get more expensive, but exports become more competitive. The classic trade-off. What about other takeaways from the Asia-Pacific region? Anything on Hong Kong in particular that stood out to you?
Well, both May and Jefferies seem to agree that it's not a great investment right now. They point to rising interest rates and weak loan growth as red flags.
So best to steer clear for the time being.
For now, yeah. It seems wiser to explore other opportunities in the region.
Okay, so we've covered Indonesia, India, and Hong Kong. Anything else noteworthy from the report?
They touch on Thailand, Malaysia, the Philippines, Singapore. But what I found super interesting was their analysis of Japan.
Ah, yes, Japan.
Yeah.
Always a bit of an economic enigma. What's their take?
Well, they spend a lot of time on the Bank of Japan and their struggle to achieve their 2% inflation target. You see, Japan has been stuck in this deflationary environment for years.
Deflation, so like the opposite of what the U.S. and a lot of other countries are dealing with.
Exactly. And they've been trying all sorts of things to get inflation up. They've kept interest rates incredibly low, even negative for a while there. And they've been buying tons of government bonds to try and stimulate the economy.
Negative interest rates. That just sounds crazy. Is it working?
Well, inflation's picked up a bit, but the report argues that it's more due to external factors like rising energy prices, not necessarily the Bank of Japan's doing. They also express concern about the risks associated with the yen carry trade unwinding, which could lead to a sudden strengthening of the yen and potentially disrupt financial markets.
Sounds like Japan's economy is a story to follow closely, for sure. So we've covered a lot. Geopolitics, the U.S. economy, China, emerging markets, even a bit on Japan. What are the biggest takeaways here for someone trying to make sense of it all and maybe make some investment decisions?
I think the most important thing to remember is that we're in a very fluid global situation.
Yeah.
Lots of uncertainty, lots of moving pieces, which makes it difficult to predict what's coming next.
You're telling me.
But uncertainty also creates opportunity. And both the Arete newsletters and this Jeffereis report suggest that alternative assets like gold and Bitcoin could do well in this environment. They also point to markets like India and Indonesia as potentially worth exploring.
So it's not all doom and gloom.
Definitely not. But it's more important than ever to do your research, understand how much risk you're comfortable with, and invest for the long haul, not just quick wins.
Great advice. And speaking of the long haul, let's go back to that labor hoarding idea for a second. What if it's a sign of something much bigger than just companies trying to get ahead of a potential worker shortage?
What do you mean?
What if it's a sign that the very nature of work is changing right before our eyes?
You mean with automation and AI?
Exactly. We're seeing insane advancements in automation, artificial intelligence, and even remote work technology. What if companies are holding on to workers now because they know that soon they'll be able to automate a big chunk of their operations? It's like they're stockpiling human capital before the robots take over.
That's a really interesting thought. It raises some big questions about the future. What does this mean for jobs, wages, even inequality?
And how will investors need to adapt? Will the traditional economic indicators even be relevant in a world reshaped by automation?
These are questions we'll need to grapple with as we go.
A lot to think about. Okay, so we've covered the global landscape, touched on some emerging markets, and now this mind-blowing possibility of a workforce revolution. What's next on our agenda for today's deep dive?
Well, the Jeffereis report spends a good chunk of time digging into the gold market.
Perfect. Let's hear what they have to say about everyone's favorite precious metal.
They do.
Hmm?
But they also highlight something else, a really fascinating example of how China is approaching their economic challenges, specifically when it comes to their central bank.
Okay, you've definitely piqued my interest. We talked about some of the moves they're making to stimulate their economy, but what's this about their central bank?
Well, the Jeffereis report calls it reverse yield curve control, and it's a bit unusual to say the least.
Reverse yield curve control. Okay, you're gonna have to break that down for me. Sounds a little complicated.
It's actually simpler than it sounds. Basically, the People's Bank of China, their central bank, is trying to keep short-term interest rates higher than long-term rates.
Wait, really? That seems counterintuitive.
Yeah.
Don't longer-term loans usually come with higher interest rates because they're riskier?
Exactly. That's the typical yield curve. Short-term rates lower than long-term rates. But China is doing things a little differently.
So why flip the script like that? What's the logic?
The report suggests a few reasons. One is to discourage too much short-term borrowing. It's like trying to prevent those speculative bubbles from forming.
So keeping a lid on those hot money flows that can create instability.
Exactly. And second, it makes long-term investments cheaper. Things like infrastructure and manufacturing, which China sees as crucial for its long-term growth.
Interesting. So by tweaking these interest rates, they can sort of steer capital towards specific parts of the economy.
That's the idea. And the report uses this as an example of how the Chinese government is becoming more and more comfortable with intervening in their economy to achieve specific goals.
It's a different approach for sure, more hands-on than what we're used to seeing in a lot of Western economies.
For sure.
Yeah.
And it highlights that there's no one-size-fits-all approach when it comes to navigating the global economy. Each country has its own unique set of challenges and tools at its disposal.
Absolutely. And we've certainly seen that throughout this deep dive. We've covered a ton of ground, from the ins and outs of the global economy to potential paradigm shifts and how we work and everything in between.
And we've seen how interconnected it all is: geopolitical events influencing markets, economic policies with unexpected consequences, technologies reshaping industries, even the very nature of work itself.
It's a lot to wrap your head around, but if there's one key takeaway I'm walking away with, it's that uncertainty breeds opportunity.
The oldest rule in the book.
And boy, have we talked about uncertainty today. Geopolitical tensions, mixed economic signals, technological disruption. It's a wild world out there. But for those who are willing to do their research, understand their risk tolerance, and stay adaptable, there are some potentially huge opportunities out there.
I completely agree. The key is to have a long-term mindset and not get caught up in the short-term noise.
Absolutely. Wise words to end on. Well, on that note, we'll wrap up this deep dive into the global landscape. We hope you found it insightful and feel a little more prepared to navigate these uncertain but potentially very rewarding times.
Here's to informed investing.
And remember, the world never stops changing, so keep learning, stay curious, and until next time, happy investing.